So, hi friends, as a part of Patwari Academy's initiative, today we'll try to understand how the exposure can be managed, the exposure management. That is, so we understood there are three types of exposure. One is the transition exposure, second is the operating or economic exposure, and third is the um, translation exposure. So transition exposure means you are exposed directly to the buyer with reference to there is a possibility of non-payment by the buyer, right? So how do you cover that risk? That's very important. So generally, it's more of a protected default by the buyer. Protected means they have the money, they don't want to pay, and then there is a possibility of voice risk, right? So you have to take the proper marine insurance cover. There is a possibility of inspection quality issue. So then you have to ensure that the goods are inspected before it is being dispatched, right? And there could be possibility of payment risk. Payment risk means how do you cover that? Either you cover through proper LC mechanism, or if there is no letter of credit, how do you cover the risk on through the ECGC or any other credit insurance? And credit insurance helps you not only covering the risk of non-payment, it also helps you in covering the geopolitical risk, like a country like Sri Lanka, Bangladesh, Pakistan, Myanmar, Bhutan. So many countries are into the geopolitical risk. Then there is a possibility of like exchange rate risk, like interest rate risk. Then you have to go for proper hedging in terms of forward contracts, future contracts, option contracts, interest rate agreements, forward rate agreements, interest rate swaps, cross currency swaps. So all these things are required to be understood. Then see, all these are very essential to understand the risk. So first you have to identify the risk, and accordingly you have to take the risk, take the action. So number one, it comes by way of investments in FDIs. If you want to set up a manufacturing unit, if you want to set up a joint ventureship, partnership, wholly owned subsidiary, or you want to do the export import business, or you want to set up a branch office, you want to set up a franchisee, anything like look at the China. So the all the companies are moving back, running away from China because they are afraid. Okay, they do not know because today you have a zero COVID policy, tomorrow you may have another policy. Okay, so and they are in fact they are supporting Russia by all means, right? Acha. Now coming to the geopolitical risk, which is very important. As I told you, so the most important is the protected default by the buyer. The buyer has the money, he doesn't want to pay. Or there could be a reason, genuine reason, like conditions of business has changed. There is a sudden, recession or depression in the market due to increase in the interest rate that can create a lot of problem to the various parties, which they have not projected properly. So no, most important is the risk, geopolitical risk, okay, and that is covered by the in India by the ECGC, and there are many more agencies. So what happened ECGC? ECGC they cover two types of risk. Please understand. One for the lenders, financial institutions like banks. What do? They provide the cover on the exporter at a pre-shipment stage. So this generally all the banks what do? They take the policy that is called whole turnover packing credit on the exporter before financing them at the pre-shipment stage. So this cover is taken by all the banks in India from the ECGC or some other agency for the finance given to the exporter or the possible default by the exporter for their inability to export the goods or any losses in the business. Number two, post shipment. That cover is provided by ECGC to the exporters against the buyer's country. So basically, they cover two types of risk. One is the commercial risk, and second is the political risk. Commercial means on the buyer's capability, buyer's inability to pay, buyer's bankruptcy, buyer's protracted default. That is most important. Change in the conditions of business. Suddenly, he's become, his mind is changed. He has defaulted on the goods. So that cover is called commercial risk. Or country risk. Country risk means change in the government, change in the political stand for import of goods, or sudden sanctions against that country. All this is possible. So what do you do in that case? In that case, that ECGC provides the cover to the exporter, okay, against this geopolitical risk, okay, and that is called political risk. So it is good for all these people. So again, I'm suggesting For transaction risk, translation risk, economic or operating risk, there is a mix of ECGC, mix of forwards, futures, options, interest rate swaps, cross currency swaps. All this needs to be taken. And more than that, you must ensure the goods are properly insured. You understand the Incoterms. As I said, suppose you go for an FOB Incoterms, then the buyer is to decide the shipping company, right? And then shipping company will follow the instruction given by the buyer. They won't listen to you. Then insurance also has to need to be covered by the buyer. And we suppose they don't take the insurance, then what happens to your goods? Ultimately, you book the loss. Ultimately, it is your loss. And if they don't pay the freight and if the goods are delivered at the wrong place, wrong hand, again you are in a problem. So you have to understand the entire, let me tell you, the Incoterms, the terms of payment, the letter of credit mechanism, the documentation they are in, then hedging of these transactions in terms of foreign exchange, then in terms of geopolitical risk. All these points has to be understood, okay? And if there is a need, you must understand, you must take the insurance against the buyer, against the country. It provides to the exporters. And you must understand the risk into the business, try to find out the line of business, rating of the business. And there is a complete package you have to understand before you export the goods or venture into franchising, wholly owned subsidiaries, or investments into the overseas host countries. So this is it's a very interesting. And next we are going to talk about the Incoterms. Huh? Okay. So thank you very much for patiently hearing. Thank you.